Welcome to Financial Insights in Minutes.
Is the financial sector on the brink of collapse?
Get ready for a deep dive into crucial market warnings and expert insights that will shake your perceptions.
Today's episode covers banking crises, debt pitfalls, and surprising economic trends.
Don't miss out on these urgent financial updates you need.
And remember to like and subscribe for more rapid summaries of the day's top financial videos.
Let's take a quick look at what's coming up. Christopher Whalen warns about an impending banking crisis with $9.3 trillion of debt maturing soon. Eurodollar University's star-studded panel discusses global banking risks and possible economic reforms. Alden talks about why fiscal dominance matters more than Fed rate changes for 2024. Danielle DiMartino Booth and Dr. Nomi Prins dive into Fed challenges and real estate woes. Tavi Costa predicts a US dollar decline and shares opportunities for savvy investors. Mike from Mott Capital highlights key risk-off signals from the strengthening Japanese yen. Elliott examines how central bank interventions have extended our economic cycle. Florian Grummes shares bold predictions for Bitcoin, gold, and a surprise asset for 2024. Welcome to David Lin's channel on YouTube. Today's hot topic: could 80% of banks be on the brink of collapse? Joining us is finance sage Christopher Whalen, chairman of Whalen Global Advisors. Get ready for a deep dive into the financial abyss.
Absolutely. Christopher delves into the looming debt crisis and the state of the banking sector. Hang tight, we're in for a ride full of financial turbulence and high-stakes predictions.
All right, let's cut to the chase. What's the core thesis of Christopher Whalen's insights?
Christopher Whalen's main point is that the banking sector is teetering on a precipice. He warns that the sector is under severe stress, with $9.3 trillion in debt maturing soon. This, combined with mismanaged assets, spells potential disaster.
Let's break down those key points Christopher discussed, starting with current market conditions. What's shaking?
Whalen points to the recent sell-offs in tech and financial sectors, largely driven by overvaluation and geopolitical jitters like Trump's comments on Taiwan. Also, a global IT outage affecting airlines and banks didn't do any favors.
Interesting. And what's he saying about the banking sector's health?
He suggests banks have been playing hide-and-seek with their losses by moving underperforming assets into held-to-maturity portfolios, thus avoiding the need to mark them to market. But hey, the numbers don't lie. They're struggling.
Ouch. What's the scoop on this looming debt maturity crisis?
A whopping $9.3 trillion in U.S. debt is up for refinancing soon. The catch? Interest rates are now much higher than when these debts were initially issued. Picture refinancing your mortgage at double the interest rate. Yikes.
So let's gaze into Whalen's crystal ball. What does he foresee?
First, he predicts more defaults, especially in commercial real estate, which could see asset values nosedive. Second, even if the Fed cuts rates, it might just be a temporary Band-Aid on a much bigger wound.
Time to wrap it up. What are Whalen's main calls to action?
He urges policymakers to embrace transparency in asset valuation and to manage liquidity more robustly. For the rest of us, it's a wake-up call. Be prepared, stay informed, and focus on financial resilience.
Welcome back to Eurodollar University. Today's milestone 100th episode is a real treat. We've shifted gears with a special panel Q&A featuring not just Jeff Snyder, but also Emil Kalinowski, George Gammon, Brent Johnson, Mike Green, Jim Rickards, Eric Bosmajan, and even a guest appearance from Stephen Van Meter at a Disney water park.
Absolutely, and what a panel it is. This star-studded lineup is set to tackle some of the biggest questions about our global banking system and economic future. Buckle up, macroeconomics fans. This is going to be one insightful ride.
All right, let's dive in. What's the main focus of today's special episode?
Today's 100th episode centers on exploring the risks and dynamics of the global banking and monetary system. The panel dives deep into issues like private credit expansion, geopolitical risks, and potential economic reforms.
Let's break down the key points discussed, starting with global banking risks. What did Emil and Michael have to say?
Emil Kalinowski mentioned the BIS's early warning indicators for private credit expansion. Countries like South Korea and Hungary top the risk lists. Michael adds that the real concern isn't just public credit, but private credit's potential to trigger systemic crises.
Moving on to economic predictions, What caught your attention there?
Eric Boss Majan explained the mechanics behind long-term rates increasing while short-term rates decrease during a recession. Jim Rickards went further, emphasizing that geopolitical risks like recent political turmoil might have more significant economic impacts.
Interesting. Now, what about the Eurodollar market and global impact?
Brent Johnson highlighted risks in the Eurodollar market contraction globally, especially if the U.S. adopts more protectionist policies. The panel also warned about China potentially devaluing its currency, which could send shockwaves of deflation worldwide.
What about the predictions? Did they have any crystal ball moments?
First, Eric Boss Majan warned of continued below-trend growth due to rising aggregate debt, leading to prolonged economic struggles and increased populism. Then Jim Rickards speculated that we might see a shift towards policies driven by tariffs and protectionism that could reshape global trade dynamics.
To wrap this all up, what were the key takeaways?
Overall, the panel underscored the need for strategic economic policies over quick fixes. While there's optimism for future technological advancements, the looming issues of geopolitical risks can't be ignored. The challenge, they agree, is making well-informed hard choices to navigate uncertainties ahead.
Welcome back, folks. We're diving deep into the world of fiscal policy and economic predictions with a summary of a fascinating interview from the Blockworks macro channel. In this video, the brilliant Lynn Alden breaks down why fiscal dominance is crucial for understanding the economic forecast of 2024 and beyond.
That's right. Lynn Alden, who's always spot on with her economic insights, is here to tell us why the market's obsession with Fed rate cuts is a distraction from the real issue at hand: fiscal policy.
So, what's the main takeaway from Lynn Alden's analysis? What's the big reveal?
The core thesis is that while everyone's fixated on rate cuts and hikes, the real game changer is fiscal policy. Alden argues that aspects like large fiscal deficits and structural economic factors are far more influential.
Let's dive into the main points she covered. Starting with resilience to rate hikes. What did she say about that?
Alden explains that U.S. homeowners and corporations are largely protected from Fed rate hikes because they hold more fixed-rate debt compared to the rest of the world. This includes long-duration fixed-rate debt, which insulates them from immediate rate hike impacts.
So fiscal dominance, how did she define and explain it?
Fiscal dominance essentially means that large fiscal deficits and government spending are more dominant factors than the Fed's monetary policy decisions. She highlighted that this became significant from around 2017 and has grown ever since.
What about potential future rate cuts?
Even if the Fed mildly cuts rates, it won't be very stimulatory. Most people and businesses locked in low rates long term, so there's not much scope for refinancing at new lower rates. Fiscal policy outshines these minor Fed adjustments.
Interesting. Now, she mentioned some economic slowdowns. What's going on there?
High interest rates are starting to bite, especially in sectors like commercial real estate and variable rate credit card debt. We're also seeing a softening in the labor market, but manufacturing has stabilized somewhat. It's a mixed bag.
All right, time to gaze into the crystal ball. What predictions did Alden make?
She suggests that a traditional recession is highly unlikely due to the high fiscal deficits. However, we might see persistent inflation. Future fiscal policies shaped by the upcoming elections will also play a critical role.
And what about the impact on different sectors?
Sectors will respond differently to the mix of high fiscal deficits and monetary tightening. For example, industries sensitive to interest rates may perform worse than those benefiting directly from fiscal spending.
Wrapping it up, what should we keep in mind?
The main point is to focus on fiscal policy over Fed's rate cuts when trying to predict economic conditions. Lynn Alden underscores the importance of government spending plans and fiscal measures in shaping our economic future.
Welcome back to the Danielle DiMartino Booth channel on YouTube. Today's episode is a real treat as we dive into a conversation between Danielle DiMartino Booth and the astute Dr. Nomi Prins.
Absolutely. We're going to break down their discussion on the Fed's challenges, economic hurdles, and insights into the real estate markets. Hang tight, this is going to be enlightening.
All right, let's jump right in. What's the central theme of their conversation?
The main thesis centers on the Federal Reserve's current predicaments, highlighting Jerome Powell's urgent task list as he navigates monetary policies and looming recessionary signs.
Cool. Let's talk about Powell's dual mandate. What's up there?
Powell's juggling as the Fed chair while trying to tighten regulations on non-bank financial entities, affectionately called the shadow banks. These guys, they've been running wild, but now it's time to rein them in.
Wow, that's massive. How big are we talking here?
Well, non-banks globally are handling about $240 trillion, dwarfing the $180 trillion held by conventional banks. Powell's starting to feel like a lion tamer in the wild.
Intriguing. Any political spices in the mix?
Here's the kicker. Despite the buzz, Powell's not playing political chess with Janet Yellen to prop up stocks. He's a political maestro, yes, but not a partisan puppet.
Got it. Now, how about those economic indicators giving Powell gray hairs?
Powell's facing heat from rising unemployment and sticky inflation. He's committed to ditching the Fed's MBS holdings and avoiding zero interest rates if possible.
And the real estate market. What's the verdict there?
Real estate. There's an oversupply in the multifamily sector. Only 47% of new apartments got rented last quarter. This glut is putting the squeeze on both residential and commercial real estate.
All right, let's gaze into the crystal ball. What predictions did Danielle make?
Powell's likely to act soon due to the clear recession signals ahead of the U.S. elections. Speaking of which, Danielle predicts that real market corrections usually occur when the Fed starts cutting rates. So buckle up.
Sum it all up for us. What's the ultimate takeaway?
Danielle's advice is all about capital preservation. Hedge those portfolios, stash some cash. It's not glamorous, but it's paying decent returns. And remember, watch the Fed's moves like a hawk. History says that's when the real action starts.
Welcome to Kitco News. Today, we're talking about the potential downfall of the U.S. dollar. Our guest is Tavi Costa, a partner and macro strategist at Crescat Capital. Get ready for some eye-opening insights.
Absolutely. Tavi Costa is renowned for his deep dives into macroeconomic trends. Today, he's shedding light on why he believes the U.S. dollar is heading for a major decline in the next few years. Fasten your seatbelts, folks.
All right, let's cut to the chase. What's Tavi Costa's main argument about the U.S. dollar?
In a nutshell, Costa is predicting a prominent depreciation of the U.S. dollar over the next 3 to 5 years. He cites high global interest rates and ballooning U.S. debt as the primary culprits. And yes, he's got the numbers to back it up.
Let's break down some of Costa's key points. First up, interest rates and sovereign debt. What's happening there?
Costa points out that high global interest rates are making debt management a nightmare for many countries, especially the U.S. The cost to service American debt is nearly 4% of GDP, much higher than countries like Japan with just 0.5%. Yikes.
And Costa mentioned something about financial repression. What's the scoop?
That's right. Costa predicts the U.S. will resort to suppressing interest rates to manage its debt servicing costs. This will likely weaken the dollar further. It's like trying to plug a leaking dam with chewing gum.
He also touched on market mispricing. What's that all about?
Indeed. Costa believes that current market conditions do not accurately reflect the potential for a significant dollar decline. He sees this as a golden opportunity for those ready to make strategic moves. Pay attention, investors.
Now, for the crystal ball segment, what are Costa's predictions?
First, Costa forecasts a substantial depreciation of the U.S. dollar against other fiat currencies over the next 3 to 5 years. He also predicts the Federal Reserve will implement multiple rate cuts, potentially 3, to ease the debt burden. Watch out for those moves.
So, what should we make of all this? What's Costa's final word?
Costa is essentially urging caution and preparation. He recommends focusing on assets that traditionally perform well when the dollar depreciates, like commodities and mining stocks. It's a strategic pivot to navigate the upcoming economic shifts.
Welcome to Mott Capital's Market Chronicles on YouTube. Buckle up because today's episode tackles a seismic shift in the currency markets. We're joined by our ever-insightful Mike, ready to decode that cryptic title, "The Yen is Screaming of Risk Off."
Absolutely. Mike dives deep into how the strengthening yen serves as a canary in the coal mine for imminent market risk-off trends. Let's explore how this impacts the broader financial landscape.
All right, what's the core takeaway from Mike's video? What's shaking the yen-tastic foundations of the market?
The main thesis here is that the Japanese yen's recent gains against the dollar hint at a global shift toward risk-off sentiment. Mike suggests that similar moves in other major currencies reinforce this cautionary trend for risk assets, like U.S. equities.
Let's dig into the specifics. What about that big yen movement?
Sure thing. The yen dropped 90 basis points against the dollar, indicating its strength. Mike zeroes in on a critical support level from July 18th. If it breaks below that, we could see the yen rally to the 151 to 152 range.
And that's a risk-off signal, right?
Exactly. A stronger yen often means investors are fleeing risky assets. Mike also talks about similar moves in the Australian dollar, euro, and others, painting a broad risk-off picture.
Interesting stuff. How does this tie into the S&P 500?
Mike notes a correlation between AUJPY and the S&P 500. Basically, if the AUJPY declines, it might set off alarm bells for U.S. equities. Same goes for movements in the Mexican peso and Canadian dollar.
Speaking of Canada, there's a big meeting coming up, right?
Yes, the Bank of Canada meeting could bring rate cuts, further impacting currency movements and market sentiment. Keep those calendars marked.
Got it? Any sector-specific insights?
Indeed. Mike points out a gamma squeeze in IWMs, increased call volume, and skepticism about the rally's durability. The Russell 2000 is also closely correlated with South Korea's Kospi index, hinting at potential future weakness.
Now, let's get to the fun part, predictions. What's Mike's crystal ball showing?
Mike envisions that if the yen breaks key support levels, it could further strengthen, amplifying the risk-off sentiment globally. He also sees declining oil prices influencing USD CAD and US DMXN, creating additional risk-off signals. And lastly, he's skeptical about the longevity of the IWM rally influenced by global market correlations.
All right, to wrap it all up, what are the big takeaways here?
Mike's main takeaway is that the yen's strength, along with similar currency moves, signals a broader risk-off environment. This could spell trouble for U.S. equities. He stresses the importance of watching these currency movements closely as early indicators of market trends.
Welcome back to Bob Elliott's YouTube channel. Today's dive is into the meaty subject of supply chains, prices, nominal growth, and their impact on our economic cycles. Bob's here to unravel this labyrinth with his expert lens.
Absolutely. Bob Elliott tackles the intricate relationships between central bank policies, inflation, and economic growth. If you've been scratching your head over these topics, stay tuned.
All right, let's cut to the chase. What's the main argument Bob is making?
Bob posits that central bank interventions in March 2023 effectively extended the economic cycle. He highlights how supply chain issues, inflation, and nominal growth have played out under these policies, averting a severe downturn but leading to a complicated economic landscape.
Great. Let's break that down. How did central bank policies impact the economy?
Interventions like the Bank Term Funding Program and a blanket guarantee on uninsured deposits were pivotal. These measures stopped the bleeding in the lending growth sector, averting a more severe credit crisis.
What about those tricky supply chain issues and inflation we've all been feeling?
Supply chain disruptions and rising input prices spiked inflation in 2022. Despite these hurdles, nominal growth stayed strong because prices rose instead of production meeting demand. Think lots of dollars chasing fewer goods.
Interesting. How did employment and income trends play into this?
High nominal income and spending kept the economy going, masking weak real growth indicators. But now income growth is fading and there's less spending power. This points to a slowing economy rather than an accelerating one.
Got it. So what does Bob foresee in our economic future?
Bob predicts a gradual economic deceleration, not a sudden drop. Employment and wage growth are still around but not strong enough to kick the economy into high gear.
Wrapping it up, what's the big takeaway here?
Bob argues that while interventionist policies have extended the economic cycle, they haven't set the stage for a robust recovery. We're heading into a phase of slower growth, reduced spending power, and a generally decelerating economy. Buckle up, it's a slow ride ahead.
Welcome back, everyone. Today we've got some heavy hitters in the world of finance and crypto predictions. We're diving into Florian Grummes' bold forecasts from a recent interview with David Lin. We're talking Bitcoin, gold, stocks, and a surprising dark horse asset for 2024. Stick around, you won't want to miss it.
Absolutely. Florian Grummes, managing director of Midas Touch Consulting, has a knack for making some pretty accurate calls. If you love market predictions, this one's for you.
So, what's the main takeaway from Florian Grummes' predictions? Are we in for some big shifts?
Indeed, Grummes expects gold to climb over $3,000, Bitcoin to reach $100,000, but surprisingly, he thinks Solana will steal the show in 2024, potentially soaring above $1,000.
All right, let's break down those key points, starting with the stock market rally. Why is it called the most hated?
Grummes mentions the rally is driven mainly by a few tech and AI stocks, like Nvidia, which makes it narrow. The broader market hasn't kept pace, creating a lot of skepticism.
Interesting. Now, what's the deal with gold?
Grummes expects gold to pull back to around $2,100 before making a significant run past $3,000. He thinks gold has lost momentum recently, but should rebound after this correction.
And what about Bitcoin? Any big moves on the horizon?
Absolutely. He sees Bitcoin potentially dropping to 50 to 55K before rallying towards $100,000 by next year. And if Trump wins, it might even hit that mark by the end of this year.
Fascinating. And how about central bank policies?
Grummes doesn't think the ECB and Fed will cut rates soon. But if and when they do, historical trends suggest markets usually sell off. So keep an eye out.
Okay, last key point. What's this about Solana being the surprise asset?
Yes, Grummes sees Solana shooting above $1,000 in a bull run. He believes it's the number 3 crypto that's poised for major gains, outpacing even Bitcoin and gold.
So let's sum up those predictions. What's Grummes betting on?
Gold over $3,000, Bitcoin at $100,000, and Solana crossing $1,000. Plus, he warns of a short-term market pullback into September and October before another rally kicks off.
What should our viewers take away from Grummes' insights?
Grummes emphasizes cautious optimism. Watch for those short-term pullbacks before diving in on gold, Bitcoin, and Solana. Stay informed about central bank actions and macroeconomic trends to navigate the year ahead successfully.
Christopher Whalen warns of an imminent banking crisis, highlighting the looming $9.3 trillion debt maturity.
Jeff Snyder and his panel discuss global banking risks and economic reforms.
Lynn Alden emphasizes fiscal dominance over Fed rate changes.
Danielle DiMartino Booth and Dr. Nomi Prins talk about Fed challenges and real estate woes.
Tavi Costa predicts a U.S. dollar decline and investment opportunities.
Mike from Mott Capital highlights key risk-off signals from the yen.
Bob Elliott sheds light on how central bank interventions extended economic cycles.
Finally, Florian Grummes makes bold predictions for Bitcoin, gold, and Solana.
While most experts agree on significant market risks and debt levels, their solutions and safe investments vary.
This divergence highlights the complexity of today's financial landscape. Stay tuned for more.
Thanks for watching Financial Insights in Minutes for July 24th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.